Welcome to the Deep Dive. Today we are really tearing into Gevo Incorporated's second quarter 2025 earnings call. That's ticker GEVO.
Yeah, and this one, it really felt like a big moment. The call was after hours, August 11th, and the market reaction afterwards was just incredible.
Incredible is the right word. We saw, a 59% surge in the stock the next day?
Exactly. 59%. That's not just, beating estimates by a little bit. That signals a fundamental reset in how investors are thinking about this company.
Right. It feels like a narrative shift. This wasn't just more progress, it was validation.
Yeah.
They hit positive net income and positive adjusted EBITDA for the first time ever.
And management even said it came faster than anticipated. That's huge. It's the shift from being, a development story heavy on promises to an actual operating company generating profit.
Okay, let's get into the numbers that drove that reaction, because they are pretty stunning.
They really are.
Yeah.
So GAAP EPS came in at positive 1 cent per share. Now, remember the consensus was looking for a loss of 5 cents.
So that's a 6-cent beat. Pretty significant swing for a company at this stage.
Definitely. Now, revenue, it was $43.41 million.
Okay, and that was actually just a hair under the consensus estimate, right? About $43.68 million.
It was, yeah. Technically a slight miss there.
Yeah.
But you absolutely have to put that in context.
Which is
the year-over-year growth. It's up around 725% compared to $5.26 million in the same quarter last year.
Wow. Okay, 725%. That kind of growth, that overshadows a tiny consensus miss.
Completely. But the one that I think really lit the fuse under the stock price was the profitability.
Right, the adjusted EBITDA.
Yeah. Non-GAAP adjusted EBITDA hit $17.3 million.
Okay, $17.3 million on, was it $43.41 million revenue?
Exactly. You run the math on that, and it gives you an adjusted EBITDA margin somewhere around 40%.
Wait, hold on. 40%. An adjusted margin of 40% in, the clean tech fuel space.
40%, yeah.
That just sounds exceptionally high for this sector. I mean, isn't this usually a volume game with tight margins? How real is that 40%? Is it sustainable, or is there some one-time thing inflating it?
That's the critical question, and the answer seems to be it's real, and it looks durable. It's not just operational efficiency. It's driven by two really pivotal financial levers they've now proven they can pull.
Okay, which are?
The Section 45Z clean fuel production credits the CFPCs and, maybe even more interestingly, the start of carbon dioxide removal, or CDR, credit sales. It's about financial architecture, not just production cost.
Got it. Okay, let's unpack the CFPC part first. You mentioned financial architecture. The accounting sounds key here.
It's absolutely critical. So in Q2, they closed their first big tax credit transfer deal. It was for $22 million worth of these 45Z credits.
$22 million, that's a big chunk.
It is. And importantly, that figure included a catch-up. It recognized credits generated not just in Q2, but also Q1 and Q4 the prior year.
Okay, so a bit of a backlog payment boosting the Q2 number.
Partly, yes. But here's the subtle, crucial accounting point management really hammered home on the call.
What's that?
These credits, they don't show up as revenue. They're recognized as a reduction to cost of goods sold. COGS.
Okay, a reduction to COGS, not revenue. Why does that distinction matter so much? Isn't money just money on the income statement?
Well, yes and no. Structurally, it matters a lot. If it were revenue, your top line looks bigger, but your underlying cost to produce might seem the same. By reducing COGS, you are fundamentally lowering the baseline cost of making your product.
Ah, I see. So every gallon they produce now looks inherently more profitable before you even get to gross profit.
Exactly. It artificially, or perhaps structurally, lowers their input costs compared to, say, a traditional ethanol producer who doesn't have this integrated carbon capture and credit monetization piece. It's a built-in advantage. That's how you get to a 40% margin profile.
And this isn't just a one-quarter boost from that catch-up.
Doesn't look like it. The guidance they gave suggests this CFTC contribution should be over $10 million per quarter.
10 million plus, every quarter. Through when?
Through the end of 2029, when the 45Z program is currently set to expire. And they were careful to call that a conservative stress number. They think they can do better.
Okay, so that's a pretty solid multi-year financial cushion they're building.
It seems like it. And they mentioned they're using the same playbook, including, interestingly, insurance products, to de-risk the transfers for the tax credits from their renewable natural gas, their RNG business too. So it reinforces that recurring cash flow idea.
All right, interesting. Now, what about the second lever, the carbon dioxide removal credits, the CDRs?
Yeah, this is maybe the newer, more intriguing piece. They just started selling these and booked over $1 million in sales in Q2, right out of the gate.
$1 million already. And they have targets for more.
They do. They're aiming for $3 million to $5 million in total CDR sales by the end of this year, 2025.
Okay, what's special about these credits? There are lots of carbon offsets out there, aren't there?
There are, but quality varies wildly. And that's the key here. These are high-integrity, certified CO2 removal credits. They call them CORCs.
CORCs, certified how?
The North Dakota facility, where they're doing the carbon capture and sequestration, or CCS, is actually the first facility in the entire U.S. to be certified by Puro Earth for CO2 storage.
Puro Earth. Why should you, the listener, care about that specific certification?
Because Pure Earth certification verifies permanence, in this case over 9,000 years of permanence for the stored CO2. This isn't like planting a tree that might burn down. This is geologic storage.
Ah, okay, so permanence equals quality, and quality commands a premium price.
A massive premium. This kind of certification gives them access to buyers, big corporations usually, who need rock-solid, auditable proof of carbon removal for their own ESG goals. Think like Microsoft or big tech companies. They can't risk buying dodgy credits.
Gotcha. So this isn't just another co-product, it's a potentially very high margin one because of that quality verification.
Exactly. Management threw out a number suggesting that long-term, this CDR stream alone, just from the current North Dakota output, could bring in over $30 million a year.
$30 million a year from CDRs. Wow, okay, that's pure upside on top of the fuel and the 45Z credits.
Seems like it. High margin upside.
So all this cash flow, the CFPC, the CDRs, it's obviously strengthening the balance sheet.
Yeah, they finished the quarter with about $127 million in cash, equivalents, and restricted cash. Solid position.
And they made some moves to improve liquidity too, right?
They did. In July, just after the quarter closed, they refinanced some bonds related to the RNG business. That freed up about $30 million in cash that was previously restricted, gives them more flexibility.
And they're trimming the fat a bit, selling off older assets.
Looks like it. They reached an agreement to sell their legacy agri-energy ethanol plant in Luferne for about $7 million. That should close by year-end. It really feels like pruning the old to pour resources into this new, high-margin, carbon-focused model.
Okay, so they're building this cash engine, which is critical because the long-term story, the big prize, is still sustainable aviation fuel, right? The alcohol-to-jet EPJ platform.
That's still the ultimate goal, absolutely. They're aiming to meet that growing demand for jet fuel in the U.S. Figures suggest it could jump by, 2.3 billion gallons a year over the next decade?
Right. So how does this newfound profitability feed into the ATJ strategy?
Well, it means they can strategically allocate resources now. They're focusing on finalizing the engineering for the first commercial scale plant, the ATJ-30. That's 30 million gallons per year.
And that's going in North Dakota.
Targeted for North Dakota, yes.
Yeah.
And the reason that's attractive is because the carbon capture assets, the CCS part we just talked about, are already there. It significantly de-risks building the ATJ plant on that site.
Makes sense. Leverage existing infrastructure. What about the other bigger project, the ATJ-60 at Lake Preston?
That one's still in development, but they're managing the pace more deliberately now. They basically said they're waiting for more clarity on two huge external factors.
Which are?
The big one is the $1.63 billion loan guarantee application they have with the Department of Energy. And the second is the fate of the Summit CO2 pipeline project, which would be key infrastructure for that site.
So they're being cautious, not building ahead of financing or infrastructure.
Exactly. They're pretty blunt. They won't build a plant that's economically disadvantaged from the start. This new cash flow gives them the flexibility to wait for the right conditions for the optimal economics. They don't have to rush it now.
Right. The credit-enabled cash engine gives them that latitude. Okay, so they have cash flow. They have the ATJ plan. What protects this whole thing while they scale up? What about competitive moats?
Good question. Beyond the core tech, there are a couple of interesting potential moats developing.
Like Verity, their software platform.
Yeah, Verity. It's easy to overlook, but it could be really important. It's their carbon tracking software. It's already generating some revenue. And they just announced a partnership with Landis. That's a big ag solutions company, like $2.4 billion big, to use Verity for tracking the 2025 soybean crop.
Interesting. So Verity isn't just for their own internal use.
No, they're selling it externally. They mentioned having 5 other ethanol plants as customers already. If they can make Verity the standard for tracking carbon intensity through the whole ag supply chain.
Then that becomes a recurring Software as a service, a SaaS revenue stream.
Exactly, a potentially high-margin SaaS business that diversifies them beyond just fuel and also feeds directly into the data needs of their SAF customers who need that traceability. It's a clever potential moat.
And underlying all of this, there's the intellectual property itself.
Right. Can't forget the patents. They highlighted having over 400 global patent assets covering the ATJ process, the ethanol to olefins tech, the carbon solutions. In a new industry like this, that IP library is a fundamental barrier to entry.
Okay, so putting it all together, that 59% market reaction makes more sense now.
Yeah, I think the market finally saw the proof points. The company is making that transition from being seen as a, pilot-heavy developer always needing cash to becoming this credit-enabled cash engine.
And that engine provides the foundation, the capital flexibility to actually go and build out the big, expensive ATJ vision without being totally dependent on the whims of the capital markets.
Precisely. They control their destiny much more now.
All right. Let's shift gears slightly, take off our analyst hats for a second.
And put on our slightly more speculative investment banking hats. For a quick thought experiment, maybe?
Exactly. Time for our This Is Not Financial Advice segment. We're just kicking around an idea here based on what we saw in the Q2 results.
And remember, everyone, this is not financial advice.
Okay.
Seriously, just an idea.
Okay, so the hypothetical thesis here really hinges on that 40% margin we discussed.
Right. The core idea is the market is now waking up to the fact that Gevo's unique setup monetizing both 45Z and these high-quality CDR credits gives them a structurally superior and likely more durable margin profile.
Superior compared to whom?
Compared to your traditional non-integrated legacy ethanol producer, the old brownfield plants. Gevo's playing a different game now, leveraging carbon finance in a way those older plants just can't replicate easily.
Okay, so if that's the thesis, what's the trade setup?
Well, the aggressive relative value play could be something like this. You go long GVO equity.
Betting on that superior margin and growth story.
And you finance it by going short a basket of those older, non-integrated traditional ethanol producers. Use them as a proxy for the legacy model.
Okay. So it's a pairs trade, essentially. Long the integrated innovator, short the legacy players. What does that hedge?
It helps hedge out some of the broad commodity risks, right? Like if corn prices spike or natural gas prices move wildly, it should impact both sides, neutralizing some of that macro noise.
So you're isolating the bet. You're specifically betting on Gevo's integration, their skill in monetizing these unique co-products, especially the CDRs where they have that quality edge and access to a supply-constrained market.
Exactly. You're betting on superior financial architecture and access to premium carbon markets, not just ethanol production volume.
What's the main risk to that trade?
The big one is regulatory risk, no question. The 45Z credits are set to expire at the end of 2029. If they aren't extended or replaced by something similar, that $10 million plus per quarter cushion evaporates.
Right, that would definitely hurt the margin profile.
It would. But the potential hedge against that risk is the CDR market. That's largely a voluntary market, driven by corporate demand, not just government policy. If that market continues to grow and Gevo maintains its quality leadership,
then the CDR revenue could provide a longer-term floor for profitability, even if 45Z goes away. It adds this layer of policy-agnostic optionality.
That's the idea. It potentially mitigates some, though maybe not all, of that political cliff risk post-2029.
Okay, it's definitely an aggressive trade idea, but the logic holds together based on this quarter. So just to recap the main takeaway from the actual earnings.
Yeah, the core victory lap for Gevo here is first profitable quarter, check. Stronger cash position with more flexibility, check. And credible proof that they can actually execute on monetizing these CFPC and CDR streams.
Which, crucially, de-risks that whole long-term SF growth story quite a bit. They've built the financial foundation now.
The foundation feels much more solid. Which leads us to our final provocative thought for you to chew on.
Okay, leave us with something to think about.
All right, consider this. We talked about the CCS capability at the North Dakota site. They have capacity to sequester, estimates suggest, maybe up to 1 million metric tons of CO2 per year.
1 million tons. That sounds like a lot more than their own operations currently produce.
Way more. So the question is, how much value is currently baked into the stock for the potential of using that excess capacity as a third-party service, offering CO2 sequestration to other industrial emitters in the region?
So becoming a regional carbon landfill, essentially.
You could frame it that way. What's that opportunity worth on its own? And maybe more strategically, what does owning that critical piece of decarbonization infrastructure mean for potential industry consolidation down the road?
Yeah.
If your competitors need somewhere to put their CO2.
And you own the only certified large-scale disposal site nearby, the ultimate competitive advantage might not even be the fuel itself.
It might just be the hole in the ground. Something to mull over.
Definitely something to think about. All right, that's all the time we have for this deep dive. Thanks for tuning in.